Hey, Saretsky here. Welcome back to the show. Lots to touch on this week. We've got some updates from the Bank of Canada, including some commentary from your boy, Tiff Macklem. We've got some big news coming from the federal government in terms of immigration. In fact, some rather large news that's going to impact immigration, population growth, rents, basement rents. I'm going to walk you through how I'm kind of thinking about that whole process. But we have to sort of frame up this week's discussion around the Bank of Canada, right? I mean, it was coming into 2024. Everybody's kind of waiting, watching what the Bank of Canada is going to do. Of course, markets right now, right? Markets are pricing in, which basically means what are they expecting? They're expecting 100 basis points of rate cuts by the end of this year. Again, whether, when, and how many you get and where, it remains to be seen. But their expectation is rates will be 100 basis points lower by the end of 2024. So, of course, everyone's kind of looking for clues from the Bank of Canada at their first meeting. And really, it was pretty much what we expected, right? An ongoing holding rates at 5%, pushing back on the rhetoric of, hey, rate cuts. I think every journalist in the room was basically asking them, when are you cutting rates? When are you cutting rates? And of course, again, think about this. If you're a central bank, there's a thing called forward guidance, right? You have to look and act tough. You can't be like, well, we're going to start cutting in March or we're going to start cutting in April, right? Like, because markets front run you, right? We've already seen every time it looks like the Bank of Canada is going to take their foot off of the accelerator, off of the rate hikes, the housing market starts to take off. So if you're looking to keep financial conditions relatively tight because you're still a little bit uneasy about inflation, and if you fully got it reined in, you can't just say you're going to start cutting and giving that precursor, right? I think what you've seen is, if you look at what's happening right from the Fed in the U.S. is, ever since they put out the dot plot charts, which is basically where does the Fed officials see interest rates, well, they put out that chart which showed they all saw interest rates lower in 2024, and then the stock market took off and whatnot. So markets tend to front run central bankers. So the Bank of Canada had to be really coy and say, hey, listen, we're going to act tough. But they did give some little clues. Now, one of the clues here from Tiff Macklem in their commentary was, if the economy evolves broadly in line with the projection we published today, I expect future discussions will be about how long we maintain policy rate at 5%. So how long we have to maintain it at 5%. So again, he's kind of setting the stage to begin that transition to easing. And again, when we get it remains to be seen. There's some things that can change, right? If housing starts to really accelerate here in the next 2, 3, 4 months, I mean, those rate hikes can get just pushed further and further out. So we'll kind of wait and see, how that shakes up, right? I mean, you can't have financial conditions ease too much, because then you start to ignite potentially increased demand and potentially increased inflation once again, which is still one of my larger concerns for, if not this year, potentially into next year. But the Bank of Canada also noted on something we've been talking about a lot, right? They've been talking about immigration and its role that it is playing on inflation. So what he said, another quote from Tiff Macklem says, we had a long-standing structural supply on housing in Canada. With the rapid rise in immigration recently, that has exacerbated the problem. And he went on to kind of talk about, right, think about it. Shelter equates to about 30% of the CPI basket. It added a full 1 percentage point to inflation last month. So so long as you continue to add, 1 million people into the year and put pressure on housing vis-a-vis rents, it pushes that CPI inflation higher than it otherwise needs to be and forces the Bank of Canada to keep rates higher. So I've said it doesn't matter if you rent or if you own, we're all paying the price for this rampant and excessive immigration growth. We're all paying the price. You're paying the price as a homeowner through higher interest rates, and you're paying the price as a renter through higher rents. And of course, we know the infrastructure issues, et cetera, but that leads me to the next conversation, which is the big announcement that we had from the federal government this week. We had the immigration minister, Mark Miller, came out and is putting a cap. He's putting a cap on foreign student admissions. Again, this is something that we've been talking about on the show for over a year, waiting for them to do something, right? I mean, we can see this housing issue that has been exacerbated in Canada. There's no way, I don't care how much land that you rezone in this country, you can't meaningfully ramp up new housing completions in a short time frame to accommodate 1 million people a year. It's just is ridiculously reckless policy. And so they finally have brought in foreign student caps. The caps are going to reduce immigration by about 30, foreign students by about 35%. So they're going to allocate it by province, basically. And how that's going to work is some provinces are going to have more capacity to add foreign students if they want to go there. And then some provinces, such as Ontario, are going to have to reduce their foreign student intake by 50%. So think about this. The bulk of, I would say, immigration and particularly foreign students are going into Ontario, right? They're all being recruited there, these private colleges that are operated out of strip malls atop of burger joints that basically give you a piece of paper that really, they overcharge you for the piece of paper that ultimately doesn't get you anywhere in life. These papers are pretty useless for these foreign students to actually really do anything with. And so Ontario is now going to be forced to cut. Moving forward, they're going to be forced to cut by about 50%. So there's going to be this ongoing fight between all these colleges and universities about who gets what supply of foreign students. And again, if you're a landlord in Brampton, Ontario, you might see some downwards pressure on basement rents in the very near future. Of course, we already know, we're watching the market closely in the GTA. We're starting to see some pressure already on rent appreciation, seeing some downwards movement in rents. We'll see if that's seasonal, if that actually continues into this year. But I think that foreign cap. Now, let's not forget, though, at the end of the day, the cap on foreign students, okay, it's still capped at 360,000 permits. You still have a permanent residency target, which is different than the foreign student cap. You still have a permanent resident target of about 500,000 people for 2025. I think for this year in 2024, it's around 480,000, something like that. So you still got a ton of people coming into the country. So the problem is not necessarily going away. They're just kind of tinkering around the edges to hopefully alleviate at least some of the crisis that we're in. But they finally got to the bottom of that. So what happens now with rates, right? I mean, we're sort of managing population growth. The Bank of Canada, are they going to start cutting rates here? That remains to be seen. One of the things that I'm paying attention to rather closely is the data from Truflation. So Truflation is a private entity that measures CPI inflation on a year-over-year basis. Now, whether you agree with the number or not, I think most people would not agree with inflation and how it's measured and how it impacts their life, right? But Truflation kind of led CPI on the way up in the U.S. It is a private sector index, so it's not manipulated per se by the government. And most importantly is that Truflation index mirrors CPI by the correlation to CPI is 0.97. So whether you agree with the number or you disagree with the number, its correlation to CPI is 0.97. So it's almost a perfect match to headline CPI that's measured in the US. So what I'm saying is that Truflation number right now is sitting at 1.8% on a year-over-year basis. That's under the 2% inflation target set by the Fed. So this is good play, and I think it's important to watch that number. If that number starts to change, going from 1.8 to 2.8, we got a real problem. If that number starts going from 1.8 to 1.6 to 1.5, you have to think that CPI follows suit and the Fed follows suit with cuts. So that number I find very interesting. Now people say, "Well, I got to dismiss that because it doesn't fit, my narrative." Well, it fit a lot of narratives on the way up. So what I'm saying is pay attention to that number. I don't necessarily have the strongest conviction today on inflation. I do worry that we haven't had that real deep recession to cleanse things out. The data is still relatively holding up, at least in the U.S. And so there is a possibility that inflation could potentially reaccelerate. We've seen this in the bond market. Volatility remains incredibly high. We're seeing, mortgage rates, for example, moving, 10 basis points a week. We're up 30 basis points already this year. So we went from 6.3 down to basically 5, now back up to 5.3, 5.4. And so, that could potentially quell the housing rebound that everybody is so excited about. I mean, I can tell you right now is that there are portions of the market in Vancouver, and we're starting to see it in parts of the GTA, are trying to front run Tiff Macklem at the Bank of Canada. If this guy is going to start cutting rates like we are being told he's going to be cutting rates, I need to get out in front of that before housing accelerates. I'm not saying that's what I'm telling people to do. I'm saying that this is what the market is anticipating. I don't control the market. I'm just telling you what I observe in the marketplace. So we'll see. We'll see if that starts to change. Bond yields pushing back up. Maybe they go from 5.3 back up to 5.7. And that instantly slows your housing market once again as we head into the spring market. But we'll watch. As of right now, things are moving. Things are moving fairly well, surprisingly well. There's portions of the market, again, that I continue to be a little bit nervous on. Others less so. If you want the bull case for single family, as I've said before, in these major metropolitan cities, I look particularly here in Vancouver, land-constrained areas where you do not add new single-family houses. You don't build them anymore. If you look at building permits in the province of BC, the lowest levels we've seen in over 30 years. These single-family houses are continuing to be wrangled up into land assemblies for townhouse development, condo development, high-rise development, and now multiplex. Multiplexes are coming. They're coming in BC. I've had conversations with several of the municipalities in the last week or so. And I can tell you, outside of the city of Vancouver, which has their own charter, you have what's called the Vancouver Charter, so they don't have to abide by the BC government legislation. Multiplexes could be a big deal. My conversations with some of these cities so far has been that they're going to be following that BC government recommendation incredibly closely. So you're going to see cities like Burnaby, Richmond, are going to allow significant density on some of these single-family plots of land. Those are the conversations that I've had so far. And so you look at places like city of Burnaby, for example, and you've got. It's not uncommon. It's not uncommon to have 50-foot or 50-foot, 60-foot, 70-foot frontages. And you think about the ability to add density on a 70-foot frontage single-family lot. I mean, very, very easy to add 3 row homes in the front, 3 in the back. Very easy to do. And so we'll see. The development industry, the building industry is still trying to figure out how do we price the land to accommodate this, and how do we build it? What sites and what properties are going to work? So there's a lot of exciting things, I think, that are coming this year for the housing market. It's going to be an interesting tug-of-war with the bond market and with inflation, and we'll see how that all shapes up. So we'll continue to monitor comments from the Tiff Macklem of the BOC. Big week. Continue to follow along. As always, we'll see you next week.